To discuss issues ranging from China to Brexit. This hour, we'll be speaking to the chair of the Brexit group at the European Parliament, the German MEP, David McAllister. Good morning, everybody. So let's look at these futures then. How do we position for the start of trading? Futures moving to the upside, so look for a bit of a bounce. There does seem to be some expectation here and in the US. US futures also pointing higher around fiscal stimulus. How forthcoming that will be, we will have to wait to see. So UK markets get underway and trading to the upside just by 0.1% or so, so making some very modest gains. First out of the blocks this morning. The IBEX is up by just over 1%. We're looking for a movement on a range of individual corporates that have been reporting today. I can see that H&M is trading up by 3.8% over in the Scandinavian markets on the back of their statement this morning. ST Micro, they gave an update to the markets, and that stock is up by 4.5%. So there are some individual corporate news stories that are sending some individual stocks higher, but we're waiting to see what happens with the likes of Rolls-Royce, the likes of Bayer. We were talking about those two stocks in our stocks to watch. But broadly speaking then, the session is off to a positive start, and the big picture is around stimulus. In the United States, we are seeing talks between Pelosi and Mnuchin, and those talks will continue today. Here in Europe, things may be looking a little tricky. We've got an EU summit taking place and questions being asked about the timing of the EU Recovery Fund. Joining us now is Mike Bell, JP Morgan Asset Management Global Macro Strategist. Markets then, good morning to you, Mike. Markets do seem to be transfixed by the fiscal stimulus story. Certainly that was the case in the latter part of September. Do you see fiscal stimulus, more stimulus as forthcoming from the US, or does it depend on the virus and where we go with that through winter?
Yeah, so our base case has shifted to being that we won't get fiscal stimulus until after the election. Obviously, if we get it before the election, then that's a positive. And I think the market has now moved to expecting that we're going to have to wait for the election before we get further fiscal stimulus. So anything prior to that would be good news. And then when it comes to the election, in my mind, the key thing is, do we get the Senate and the House and the presidency all lined up so that you could potentially see quite a big fiscal stimulus package in that scenario? So if, for example, we got a Democrat clean sweep, then I think you'd see significant fiscal stimulus. And there's a kind of debate in markets at the moment as to whether a blue wave, a Democrat clean sweep, would be a positive or a negative for markets, weighing up that potential for further fiscal stimulus against the fact that you'd probably also see corporate tax rises. And in my mind, it's that further fiscal stimulus that would probably win out, with the corporate tax rises coming through once we saw an economic recovery underway. And so I actually think that the election could lead to a quite significant fiscal stimulus that would be supportive for the economy.
And how do you view the stumbling we're doing around the recovery fund for Europe, Mike? Do you think that this was always inevitable? There was bound to be some to and fro around how exactly that fund should be distributed, and it'll still arrive on time at the start of next year? Or do you think this is something material that we need to watch for, the falling out over how the rule of law should be tied to the distribution of these funds?
I think ultimately they'll get it over the line. I think it's so important at the moment. It was such a symbolic move If they fail to get it over the line, it would be very problematic, I think, for the market's interpretation of the sort of progress and the direction that the Eurozone is heading in. So I think they need to get it over the line, and I think they will. But whether it gets delayed or not, I think that is still open to question. And obviously, the sooner it comes, the better.
Let me ask you about something I know that you've been looking into, in particular around Brexit. We've got the European leaders meeting, and they're talking about the recovery fund, but they also might be talking about Brexit and trying to break the impasse on the trade negotiations there, Mike. So that's the sort of news peg for the conversation today. But you've been looking at how small versus large cap stocks perform, how the pound performs. How are you expecting those assets to perform if we look at either a no deal or a skinny deal?
Yeah, so our base case is that we get a skinny deal, which is, I think, what the market is pricing in at the moment. So that probably wouldn't have a significant impact on pricing from here. But in the event that we get a no-deal Brexit, which, as I say, is not our base case, but it's not a negligible risk either, then I think what you'd see is that sterling would fall quite sharply. And as a result of that, as you can see from the chart here, you tend to see the FTSE 100 outperforming the FTSE 250 in an environment where sterling falls sharply. So we think it makes sense, just given the fact that that no-deal Brexit risk is not completely negligible, to avoid having substantial overweights to mid and small cap stocks in the UK until we know the outcome of the Brexit negotiations. I think that's particularly pertinent in light of the fact that actually, if you look at the average fund in the UK equity space, it's got about a 50% allocation to mid and small cap stocks compared with the FTSE All-Share benchmark of about 20%. So that's a massive bet on Brexit going well and getting a deal. And I just think that it's worth narrowing that bet a bit and getting a bit more closer to neutral in terms of size.
Yeah, well, where do you think the impetus to do it? Is this material for the Eurozone to get a deal done on trade around Brexit? I mean, you can look at the percentage of an economy that is exposed to a particular trade flow, but you can also think about the dire strait that some of these economies are already in and wanting to avoid that dire strait to get any deeper. What do you think happens from here then, Mike? I've been looking at some of the most recent high-frequency data on Germany versus other parts of Europe, and Germany does seem to be performing pretty well when you look at footfall, for example, on German high streets. What's your assessment?
I think it's still very much in the interest of both sides to get a deal done. The UK exports about 14% of GDP to the EU. The EU exports about 3% of its GDP to the UK. So it's much more important for the UK than it is for the EU. But nevertheless, the EU would still take a hit in a no-deal Brexit scenario. And so I think both sides want to get a deal done, and it's in their interest to do so, which is why I think that's the base case, albeit a skinny deal. But as you say, the risk is that perhaps, particularly if they can get this recovery fund over the line, perhaps the Europeans just take the view that, well, we can do more fiscal stimulus if the UK aren't willing to play ball and to try and prop up the economy in the event of a no-deal Brexit, and that perhaps UK politicians misjudge the Europeans' willingness to do that, and therefore we kind of end up with a no-deal Brexit at the end of the year. So, as I say, I don't think that's the base case, but I don't think it's a very, very low probability either. And therefore, in my mind, it makes sense just to make sure that you're not taking a massive bet on Brexit going well. And the simplest way of doing that is to avoid those overweights to mid and small cap stocks, in my mind.
Mike, thanks very much. Mike Bell, stay with us. JP Morgan Asset Management Global Market Strategist. Let's just have a quick look at how some of these stocks are performing on the markets this morning, some of the stocks that we've been tracking for you. We'll start with Bayer, and we see that stock moving to the downside quite substantially, down by 12%. This on the back of a plan around cost cutting, the pressure that the agricultural part of the business is under in particular. Rolls-Royce down by 3.7%, raising new funds at that business. We'd already heard about a plan to raise 2.5, looks to be around 3 £3 billion instead. This is a combination of a rights issue and also debt. And H&M, we got more details behind the strong performance that pushed the stock higher in the middle of last month. That stock up another 5.5% on some of their store closure plans. So a little bit of retrenchment in terms of the distribution outlets for H&M clothing. Coming up on the program, 8 minutes into your trading day, how does a vaccine change the market outlook? We'll discuss that next with Mike Bell. This is Bloomberg. Welcome back to the European Market Open. 11 minutes into a trading session that is broadly positive for European equity markets. Bit of breaking news coming through this morning from the ECB. Euro area spare cash exceeds 3 trillion euros for the first time. So this is the amount of money that banks have been depositing as cash at the ECB. Is this a positive or a negative? They can't pay it out in dividends, so they've got to put it somewhere, perhaps. Should they be lending it into the real economy? That might be seen as a negative then. But on the other hand, maybe it means we don't get a liquidity squeeze if things get really tough and we start to see companies' balance sheets coming under even more pressure. So at least the banking sector does have this very large cash pile at their disposal. Really interesting to see this ECB excess liquidity update coming through this morning. Now, European regulators are set to start an accelerated review of the potential coronavirus vaccine from Oxford University and AstraZeneca. The so-called rolling review allows regulators to see trial data while development is still ongoing. Reuters is reporting US regulators have widened the investigation into the incident that led to a halt in the trial. So here we have some positive news and some blocks on the path to a vaccine, I suppose. Mike Bell, JP Morgan Asset Management Global Market Strategist, is still with us. So sort of mixed sentiment when it comes to vaccine news flow overnight, Mike. Of course, the vaccine would be a game changer. I wonder what it is about the vaccine process that would be a game changer. What is it you're waiting for? What would the red headline across the Bloomberg have to say, Mike, to make you take your current positioning and turn it into a sort of more risk-on, vaccine-related strategy?
I think if we get news, for example, out of the Oxford vaccine trials in the UK, that the vaccine has a pretty high effectiveness. In other words, that it does a good job of making sure that the vast majority of people who are vaccinated don't go on to either end up in hospital or die from the disease, then that would clearly be a pretty significant positive. Now, yes, there's almost certain to be a time lag in terms of rolling it out around the world, and perhaps approval processes might take longer in certain other parts of the world. But I think if you got that good news out of the UK trial, which we could see really at any point in the next couple of months, then for me that would be a game changer, and it would make me want to go from currently a relatively neutral view in terms of risk assets and equities to being much more substantially overweight risk. And I would look to go overweight value stocks in the US and overweight EM stocks as well, and possibly even to put a small overweight in UK equities in that scenario. Because I think what it would do is it would give us clarity that we're past the worst of this globally. This was obviously a recession caused by the virus, so if you know that the virus is going to even be it in a year or two's time, once the rollout has taken place, is going to be less of an issue, then I think that lets you know that we've started a new sustainable multi-year economic recovery, which would make me much more bullish on the outlook.
And so that's where you would move to if we get some further positive news around the vaccine, Mike. I see that at the moment you're overweight infrastructure, and I wonder, is this a hunt for yield? What is it about infrastructure at the moment that you think delivers, and what happens to that if we get a virus vaccine?
Yeah, so I think at the moment it makes sense to be sort of broadly neutral in equities, underweight government bonds, and overweight things like infrastructure and macro strategies, because the macro strategies have historically been able to provide downside protection when equity markets have been falling, and infrastructure provides a stable income in the way that you used to get from government bonds, whilst also being relatively defensive. So I think it's that blend of infrastructure and macro providing the diversification, and in the case of infrastructure, the income, as a kind of replacement for government bonds, given that yields there are so low. So that's what I'd be doing at the moment. But as I say, if you get a vaccine, then I think it makes sense to shift to a significant overweight in equities and take government bond positions even further underway.
Okay, thanks very much. Thanks very much, Mike Bell, JP Morgan Asset Management Global Market Strategist. Mike will be continuing his conversation with me on Bloomberg Radio at 9 a.m. UK time. I'll be joined there by Caroline Hepker this morning. Let's get to some further breaking news. We've heard from the ECB about the amount of cash that banks are stashing with them. We also get some breaking news this morning on PMIs in manufacturing across Europe, and it's the turn of Spain to go first. The PMI rising then for manufacturing to 50.8. The forecast was for 50.5, so a little bit ahead of estimates, but certainly above 50, and that might be reassuring to some. We'll wait to build a bigger, broader picture of that number as we go through this morning's session. Coming up, Palantir slips on its debut as a public company after an unusual direct listing. We'll hear from one of the tech company's founders next. This is Bloomberg. Welcome back to the European market open. 20 minutes or so into a trading day that's actually really quite positive. The CAC 40 in particular up by 1.3%. Now, in a hot market for new technology stocks, it was Palantir's turn in the spotlight this week. The debut via a direct listing wasn't a complete showstopper as the company failed to capture the previous $20 billion valuation. The data analytics company, co-founded by Peter Thiel, fell 5% on its debut. Palantir's other co-founder, Joe Lonsdale, spoke to Bloomberg about the concerns over the company's governance structure.
You know, if you invest in Facebook, you're making a bet on Mark Zuckerberg, and that's been a very good bet if you look at how he plans 5 or 10 or 15 years ahead and how he's thinking about that company and making sure he's growing it. And, you know, Peter, Alex, and Stefan are the type of people who they're also planning 10 or 15 years ahead. They also really care about their reputation and about their principles. And, you know, these guys are guys I would not bet against. And so that is the bet you're making, is their values and principles and their competitive spirit.
Some people are wondering why Peter Thiel hasn't been around. He wasn't part of Investor Day. He's the chairman of the company. Where is he?
Oh, well, you know, Peter's always played a very important role in Palantir. It's never been as the front and center person. He's always been in the background. He was not an operator, but he was a really key person as a co-founder.
Joe, there remains something of a fog of mistrust and skepticism around Palantir that dates back to its time as a more secretive company. Why do you think it persists?
You know, Palantir is really good at attracting the best technologists in the world and building amazing technology products and solving hard problems. They're really not very good at PR. I'm frankly not very good at it either, but I'm the best they've got, so they let me come out here to say hi to you guys. But, you know, honestly, this is a company that's continued to save billions of dollars for the government. It's continued to do really important work and protect civil liberties. It's very hard to explain what Palantir does. Most people think it's an analytics company. Frankly, it's not an analytics company. It's building information infrastructure that allows analysts to coordinate massive amounts of heterogeneous data and to build information environments to solve hard problems with that information. That's kind of a mouthful. So, I mean, it's just even what Palantir does is esoteric enough that I don't think people understand that it's the important work that it's doing. So, and frankly, they're not very good at explaining it to people outside of their clients.
Whether it's mistrust, whether it's skepticism, or as you say, a misunderstanding of what Palantir does, do those things concern you? Now that it's public, people have to make decisions every day about whether they should or shouldn't own it.
I think that Palantir should continue to improve its PR and communication skills. I think that it'd be great to educate people more about exactly the types of problems we're solving. I mean, even just walking somebody through one of these problems would probably take about 10 minutes. You have these 200 databases. You have rules about who can see what. You have to augment people and help them with their intelligence, see what's going on. You're not solving the problem for them. You're helping them solve the problem. What these problems look like in the intelligence world, in the worlds of healthcare and energy and aerospace, it's something you have to take people through. And if you give me 20 minutes with a smart person, I can get them fully aligned on it. I think hopefully Palantir figures out how to get more people to take the time to learn about these things. It's a non-trivial type of company.
Well, that is the duty of the investor, to inform herself or himself as to what it is he or she is buying or selling. Joe, Palantir helps governments and some companies do things people find unsettling, like spying. Why should we trust Palantir's intentions?
Well, you can kind of go back to the core principles and, why did hundreds of the best engineers in Silicon Valley get together to work on this after 9/11? And it was pretty clear, a lot of us as computer scientists, we have stories of how the NSA was way ahead of Silicon Valley in the 70s and 80s. And it was really disheartening to see how far Silicon Valley had gotten ahead of them. But I don't think anybody wants the government wasting billions of dollars on these projects. I don't think anybody wants the government using systems that don't secure civil liberties, that don't have privacy engines built in from the start. And so, I mean, if Palantir was the first solution out of the box, they could replace the need for billions of IT services spend that would secure the data and make sure make sure we're watching the watchers. And, you just have to look at it. That's why Palantir's continue to win all around the world in over 30 countries, because it is the best solution that does this best while protecting the data.
That was the Palantir co-founder, Joe Lonsdale. A really interesting conversation there with my colleague Eric Schatzker about the intentions of the business and the story behind it. Let's get a Bloomberg Business Flash for you this morning. Here's Laura Wright.
Thanks, Anna. Bayer is planning to cut 1.5 billion euros of costs and may sell some of its businesses. That's as the pandemic has hit the agricultural sector harder than expected. The firm is also joining peers in looking at cutting jobs. Bayer shares falling this morning as it forecast earnings per share will fall in 2021. American Airlines and United will start laying off thousands of staff as originally planned, but both have vowed to reverse the job cuts if the government agrees to provide additional aid in the next few days. American is cutting 19,000, while United is laying off about 13,000. The moves raise pressure on Washington to agree on a new stimulus plan. More than 500 JP Morgan staff got taxpayer assistance aimed at helping businesses through the pandemic, and dozens of them should not have, with some staff abusing the program. Sources told Bloomberg of the internal investigation, the scale of which has not been previously reported. The bank declined to comment. That's your Bloomberg Business Flash. Anna.
Laura, thanks very much. Laura Wright with that Business Flash. Let's get to some of the movers this morning. Laura's been through the stories, the story around Bayer and some of the other business news stories, but here's some market reaction for you. Interesting to see Cranes and Cargo Tech jumping so much. This is an entirely Finnish deal between these two businesses. I can tell you that Cargo Tech is now at 15.5%, Cranes up 13.7%. The two companies, one that handles cargo, the other that makes lifts and lifting equipment, both of them jumping as they agreed to combine in a share swap deal. H&M also moving to the upside, 6.75% to the upside. This after strong gains in the middle of September. They beat analyst estimates then for the business. Now saying some things that have comforted the market in terms of store closures, unfortunately, also on inventory, and so that stock moves to the upside. Rolls-Royce also very much in focus today. We get some further lines keep coming through from Rolls-Royce. The big focus today is, of course, on raising money to shore up the balance sheet, and they're doing that with a rights issue and also through debt. But we also have some detail around the current trading of the business, and remember that this is a sector that's really under pressure. Engine flying hours for September, not too bad, is the latest line coming through from the CFO of Rolls-Royce. Next, Brexit exodus. Financial services firms in the UK have shifted about 7,500 employees to the EU. That is ahead of Brexit and its full impact, of course, after transition. We'll speak exclusively to the Brexit Group chairman at the European Parliament next. This is Bloomberg. Welcome back to the European market open, 30 minutes into a trading session that is stronger. There seems to be some expectation around fiscal stimulus, and that seems to be pushing markets a little bit higher. We have some strength coming through, in particular in the French market. The CAC 40 up by 1.2%, but all sectors in Europe are moving to the upside, and US futures point to the upside as well. US futures up by between 0.8% and 1% right now for the major indexes. One stock that is in retreat, though, in London today is Rolls-Royce. The stock is down by 2.3%. Rolls-Royce plans to raise as much as £5 billion in new financing amid a collapse in demand due to the coronavirus. Our Bloomberg transport reporter Charlotte Ryan was at the Rolls-Royce media call and joins us now. So Charlotte, bring us up to date. What's the new information that interested you this morning?
Yeah, so this is an announcement we have been waiting on for some time, and the company has announced this morning that it plans to generate £5 billion in new financing through going to shareholders for a rights issue, and then a further £3 billion in bonds and loans. I think the key new information we got this morning was that the company is pretty confident that it's job done, as the CEO said, with this financing plan, and this should take it through even the worst case scenario of another large second wave of COVID.
Yeah.
But obviously, yeah.
Yeah, so this is what they think they need to shore up the balance sheet to get them through the winter, which is interesting in itself. What about the sort of frontline performance of the company at this point then, Charlotte? I was drawn to the comments from the CFO saying that engine flying hours for September are not too bad, and this matters, that the number of hours that their engines are in the air is something that they earn money on.
Exactly, that is one of the key metrics for the company. I would say not too bad. It's maybe a case of taking a glass half full approach, as we do know that overall the company's engine flying hours have been significantly hit by the pandemic. They had started to improve in August, and I think what they're saying is that gradual improvement has continued. But I don't think we can conclude from that Rolls-Royce is out of the woods, particularly with the fact that we are seeing the cases rise again across Europe and elsewhere in the world.
There was talk of sovereign wealth funds being involved and putting some money into the business, but I think your reporting suggests that there was some pushback against that.
Yeah, so the company, with this latest announcement, is turning to its existing shareholders rather than sovereign wealth funds, something that might be a bit of a relief to UK-based employees as well, because the company does already have a presence in Singapore, and there was some concern that getting a sovereign wealth fund from Singapore involved might have meant moving more work there. So yeah, from what we understand now, they're focusing this on their existing investors. But it's also important to point out that a lot of this plan is conditional on those existing investors being willing to buy more shares. The additional £3 billion in bonds and loans that the company hopes to secure is conditional on that backing from the shareholders.
All right, Charlotte, thanks so much. Thanks for bringing us up to date with this really interesting story, really at the coalface of what's going on in terms of business response, business fallout from the pandemic. Bloomberg's transport reporter, Charlotte Ryan. Now, financial services firms in the UK have shifted about 7,500 employees and more than £1.2 trillion to the EU ahead of Brexit. That is according to a new report from EY. And it says more are likely to follow in the coming weeks as the end of the transition period looms. Our reporter Maria Tadeo is in Brussels getting the latest on the Brexit story and the trade negotiations that are still to be finalised. Maria.
Yeah, Anna, we're here at the European Parliament. We are joined by a very interesting guest, I would say, on a day like today. It's David McAllister, who is the Brexit Group Chairman here at the European Parliament. And, we have a lot to talk about Brexit, but before I do want to put a question that is creating a lot of talk in the market, and it has to do with the recovery fund. This idea of will it be ready by the start of 2021? You know the gist at the European Parliament. What's your take on it?
Well, I do hope that the recovery fund will be operational as soon as possible, and the sooner the better. And I think it's important now that Council and Parliament sit down, that they discuss the main issues where we still have differences, and that we get it done the sooner the better. But both sides have to move.
And again, just to make it very clear, because for investors, this is something that they really care about, you do believe that there's enough time from now until the end of November, start of December, to really iron some of those differences?
Well, it's difficult for me to speculate about a date, but I think the political will on both sides must be that we get it done sooner than later, because we need the money to flow.
And speaking of political will and going back to Brexit, which is something that I know you follow very closely, I mean, the question everyone is asking in Brussels is, are we going to enter the tunnel by the end of the week or not? What's your take on that?
Well, the negotiations certainly have entered a very crucial phase. Today, in 3 months, the United Kingdom will have left the single market and the customs union, and we now really have a window of opportunity to find a deal or not. I think a lot is at stake now. One thing is clear, by the end of this month, latest 31st of October, we need a ready legal text, because we need time in this Parliament to scrutinize a possible agreement.
So it's 4 weeks, essentially, that's left to get something on paper that you can ratify and vote on. Do you think the Brits get this? Because the sense I get at the European Parliament is that, to some extent, they're wasting time, and I'm thinking of the Internal Markets Bill, which is very problematic still. So do you think they get it?
The European Parliament has been very clear with the deadline, the 31st of October, but I do understand that the British know this, because we have made clear that this European Parliament works a bit different than the House of Commons. We need to involve our committees, so if we get it done by the 31st of October, then it should be able to get it through Parliament until Christmas.
And everyone is waiting for Michel Barnier, including the European leaders meeting here today and tomorrow. What do you hope he can bring on from the negotiations? What is a crucial detail that you would like to see him say, okay, now they've finally moved?
Michel Barnier will inform the European leaders and also the UK coordination group here in the European Parliament on Friday. We still have 3 major obstacles in the negotiations. One is the level playing field, the second one is fisheries, and the third one is a solid governance structure. I do hope that we now actually move forward. The European Union is offering the United Kingdom something we've never offered a third country before: quota-free, tariff-free access for goods to the world's largest single market. But this comes at a certain price, and it's very important that we have fair competition standards on both sides of the channel.
And, you know, I often hear when you look at the entire negotiation that 90% of the deal is ready or could be ready. It's the 10% that it's still very political that's missing. Would you say that's a fair description of where the negotiation is at? 90% ready on a technical basis, 10% is the politics?
Well, both sides have made progress on a number of issues, but those issues which are still open, where obstacles remain, are of fundamental importance. We in the European Union are very much for competition, but competition has to be fair, and that's why the level playing field is of crucial importance for us.
And where can the European Union move? Because I guess that's the other side to this argument. If they move on those 3 issues, what can the European Union offer in return? Because ultimately something's got to give on both sides.
Both sides have to compromise, and to compromise, both sides have to show flexibility, but you have to show flexibility without violating your own principles. We understand that the British government has red lines, but we also have our principles, and one principle is that we have to protect the integrity of the single market. Of course, the ongoing negotiations have been burdened by the so-called UK Internal Market Bill, which, from our point of view, is a difficulty in implementing the withdrawal agreement. The withdrawal agreement, and especially the sensitive protocol in Ireland and Northern Ireland, is key for us. It's a kind of a litmus test for confidence and credibility in this ongoing process.
And just a final question, you know, when I speak to officials behind the scenes, they sometimes tell me Boris Johnson is negotiating like a madman, he's negotiating like Trump. The problem is the UK is not the US. Would you agree with that?
I'm not in a position to comment on how the UK Prime Minister and his team is negotiating. We accept the British government. This is the British government. We want to get a deal done from the European point of view, from the European side. I strongly believe that it's better to have our future relations grounded on a solid legal basis. That's why until the last minute we will keep calm here in the European Union and continue to negotiate.
Well, keeping calm. That's very European. Well, Anna, that's it from us. That was David McAllister, who is the Brexit Group chairman here at the European Parliament. Of course, on a crucial day here where European meetings, or European leaders, I should say, are meeting for the next 2 days. Brexit on the agenda pretty much every day here.
Maria, thank you very much. Keep calm and keep negotiating. I can see that on a mug or a poster somewhere. Our reporter Maria Tadeo on the ground there with European Parliament Brexit Group Chairman David McAllister. New lines coming through from Tokyo. We saw the closure for an entire day of the Tokyo Stock Exchange, of course. We're looking at live images coming to us from Japan, where the TSE is holding a press conference to explain today's trading hold. Some of the interesting lines coming through, the most important of which, Japan Exchange will restart its system and aim to resume trades tomorrow. So we're hearing this from the Japan Exchange itself, aiming to put fallback systems in place to prevent a recurrence of this, working for trading to resume as normal tomorrow, so on Friday. We're also hearing from the Chief Cabinet Secretary in the Japanese government, that is Kato, talking about how the TSE says the possibility of a cyber attack was extremely low, and we understand that hardware problems have been cited for this. The problem was caused by failure in a trading system equipment, according to that same Chief Cabinet Secretary. So these live pictures coming to us from Japan right now. Coming up, less business travel, more last-minute bookings, and a rise in one-way trips. Amid thousands of job cuts in the industry, we will speak to Skyscanner next about how air travel will be forced to change. This is Bloomberg. Welcome back to the European Market Open. We're 44 minutes into a trading session that's positive. You can see that the CAC 40 outperforms just a little. The DAX up by 0.1%. Bayer is a significant weight on German trade. That stock down by 11.7%. Elsewhere, we seem a little more hopeful. The FTSE 100 up by 0.8%. Now, American Airlines and United are cutting a combined 32,000 jobs. The layoffs were planned, but both have vowed to reverse course if the government agrees to provide additional aid in the next few days. American is cutting 19,000 staff, while United is laying off about 13,000. The move raises pressure on Washington to agree on a new stimulus plan. Closer to home here in Europe, we've heard from Rolls-Royce the way they're having to shore up their balance sheet to try and tackle the slowdown in commercial aviation. Let's speak to Hugh Aitken, Skyscanner's Senior Director. He joins us now to discuss the company's new report, The New World of Travel. So there we've got, Hugh, good morning to you. Two signs of pressure. One is job losses taking place in the sector. Another is an engine supplier having to shore up its balance sheet. When you look at your report, does it give us any clues as to when or if we will get back to 2019 patterns of travel?
Yeah, sure. Yeah, I think, the report that we published, Anna, had a couple of themes in it. One is travel is different now, and it will probably be different for a period of time. So we've seen a significant uplift in people searching for one-way trips, and also people searching for domestic, and that's very dynamic, actually. For example, we saw a big uptick in Australia searches last week, Japan the week before, as restrictions start to get eased. And the third thing is shorter booking windows. So airlines having to adapt to the fact that borders are opening and closing. We've seen plus 12% of people searching year on year for travel within the next week. So very different demand. Also, the needs of travellers are changing. So they're wanting much greater clarity and transparency. They want to provide flexibility. The top three reasons the travellers in our surveys are saying is well-being issues, safety on board, safety of them and the crew, versus price, which was this time last year. And also
so lots of themes. Yeah, so lots of themes coming out of this piece of research then, Hugh. Why do we see this rise in one-way searches persisting? That seemed obvious at the height of the pandemic or just in its immediate aftermath. Why now do you think that we see this?
Yeah, I think you're absolutely right. If you look at our demand as the pandemic started to take off and borders closed, there was a huge uptake in one-ways as people trying to get back home. Also, I think we've seen dynamic, as we all know, borders have been getting open and closed. So again, people have been clamoring to get back home. But I think it just befits the need for, there is a lot more flexibility, people having to plan shorter trips or planning a shorter booking window, and that drives a type of one-way traffic that we don't normally see.
So that's why we're seeing that. In terms of business travel then, I mean, historically, business travel has been used by flag carrier airlines, at least, to subsidise other parts of their product offering without so much business travel. And that does seem to be an area that people will find other solutions for. They just won't travel as much as they used to. What are those airlines going to do? Are we going to have to start paying more for leisure trips?
I think there's a couple of themes in that. In our research, we're definitely saying that business travel will change. Will it change? The extent of the change, time will tell. I think, as we all know, we've been used to technology over the last few months, so that will remain. We do believe there'll be an element of business travel. I think the question will be innovation that the airlines can show. So, for example, will cabin classes have to change? Will businesses trade down to cabin class because of the economics that we're all facing at the moment? So I think there's going to be quite a lot of dynamism. I think what it does play into perhaps more is point-to-point travel and people wanting to travel directly to places rather than transferring, and that's going to be an interesting trend. But importantly, how does the industry respond to that and the well-being? For example, there was reports yesterday about airport testing at Heathrow being tested, and we see that as a huge uptick in confidence. 85% of people we surveyed said they'd feel more confident travelling if there was airport testing, and I think that's going to be a real stimulus in how the industry can show flexibility to encourage business and leisure travel back.
Yeah, and on the subject of testing, there does seem some governments are hesitant to put these plans in place because they don't see them as fail-safe. Some people point out that, you can still have the virus and it's not detectable for a few days. And so it's not good enough just to test once on arrival, for example, or once before you get on a plane. What is the conversation around testing within the aviation sector at the moment, though? How hopeful does that look as a way of unlocking the sector?
Sure. So I think in general, the sector is saying testing has to be key to getting people flying or more importantly, increasing the confidence that people have in flying. So testing has to be that key and a much greater testing. And there's been trials, for example, in Italy of testing at the airport before you get on board. And in different countries, there have been different types of tests. But I think we are saying critically in industry, and the airlines have been talking to governments all over the world about how can we get testing done at the airport before people get on board. And you know, airlines are taking initiative as well as some governments taking initiative.
Thanks very much, Hugh. Good to speak to you. Hugh Aitken, Skyscanner Senior Director. Thanks very much for bringing us the latest on your report. Interesting reading. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. Goldman Sachs is resuming job cuts. Sources tell us the firm plans to eliminate about 1% of its workforce, roughly 400 positions. The longevity of the pandemic is forcing the biggest banks in the US to re-examine plans to wait out the turmoil. Wells Fargo, Citigroup and JP Morgan are all planning cuts. Bayer is planning to cut 1.5 billion euros of costs and may sell some of its businesses. That's as the pandemic has hit the agricultural sector harder than expected. The firm is also joining peers in looking at cutting jobs. Bayer is still wrestling with litigation over Roundup, the weed killer it inherited when it bought Monsanto. That's your Bloomberg Business Flash. Anna.
Thanks very much, Laura. Laura Wright here in London. I promised PMIs throughout the programme, and we're getting those coming through now. We had those Spanish numbers. We've got France now. France, September manufacturing PMI, 51.2. The prelim was 50.9, so a little bit of a rise. Once again, we see that. We saw that earlier on, didn't we, with some of the other numbers. And Italy, September manufacturing rising to 53.2. The forecast, though, was 53.5. The Spanish number, we've got PMIs rising to 50.8. The forecast was 50.5. And the Euro area spare, well, we brought you that number earlier on about the Euro area spare cash exceeding 3 trillion euros. All of that of interest, no doubt, to those following the European banking sector. But no great moves, perhaps, in the European manufacturing picture from that PMI data. But at least it is all still above 50, which suggests expansion. We are 51 minutes into our trading day here in Europe. Up next, which currency correlations remain valid? We'll put that question to the Markets Live team. Eddie van der Walt joins us next. This is Bloomberg. Welcome back to the European Market Open. European equity markets then making some decent moves to the upside, apart from the Xetra DAX, which is fairly flat this morning. Buyer a big weight on that market. Let's get to the Markets Live conversation and talk to our Markets Live editor this morning, Eddie van der Walt, who's with us. Eddie, good to speak to you. Let me ask you about the 3 trillion euros parked at the ECB then. Is this a positive or negative for risk assets that banks within the Eurozone have lots of cash on hand? That's great for their balance sheets, but they're not lending it. What does it mean to you?
Yeah, I think that you've nailed it on the head there. I think we do need to see this money being put to use for it to be ultimately useful for the economy. The 3 trillion number, it's a nice round number. It wasn't a major surprise though. I mean, we were knocking on the door all through August and into September, and we did have the Teltro settlement yesterday. So people were expecting to get through this number, but it just serves to highlight that banks are sitting on a lot of cash. We do need to see that sort of money being put to use.
And what about FX markets and the correlations we normally see and how they are performing as we come out of the first phase of the pandemic and into another one then, Eddie? It seems as if the Markets Live team have been asking a lot of questions this week around correlations generally. What responses have you been getting around currency correlations?
Yeah, you're right. I mean, correlations is very close to the heart of both to Markets Live and to its readers. And look, we've looked at it throughout the week. I think in the FX space at the moment, there is only one currency that matters, and that's the dollar. And the dollar has acted as a haven, and it is. But what we've also seen is we've seen other havens like the yen sort of break down with wider risk assets. And the only one I really want to look at the moment is the dollar, and to see whether it can continue this mini uptrend that it had through the last week or so, or if this retracement that we've seen in the last few days is telling us more about where people are putting their money and where people are with regards to risk.
Eddie, thanks very much. Thanks as always. Yeah, and I know today that the pound is losing 0.3% against that falling dollar, which is even more of an achievement. Eddie van der Walt then from our Markets Live team. That is it for the European Market Open today with Bloomberg TV. Up next, we will have surveillance and their special ETF programming this morning. This is Bloomberg.
Technical difficulties. The Tokyo Stock Exchange halts trading for the entire day, the worst ever outrage for the bourse. European leaders gather for a special summit in Brussels. Relations with China and sanctions on Belarus are on the agenda. The EU's recovery fund isn't, but concerns linger. And H&M announces plans to close 5% of stores. Shares rise, and will speak to the retailer's chief financial officer. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. The markets are actually a little bit on the up today on hopes that we will get some kind of stimulus in the U.S. market, also focused on some of the earnings that we're getting. So let's bring you exactly what we're looking at. European stocks are opening higher. Again, there seems to be potential progress in Washington towards a fresh fiscal stimulus package. Dollar falling on Thursday just after ending its worst quarter in more than 3 years. And then again, just a reminder that the Tokyo Stock Exchange halted trading after its worst breakdown. Now, coming up later, the world's biggest ETF provider has launched a synthetic S&P 500 tracker. We'll speak to BlackRock's head of iShares for EMEA, Stephen Cohen. Our weekly show, ETF IQ Europe, is in 30 minutes from now. But first, let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Good morning, Francine. The Federal Reserve is extending its limits on dividend payments and buybacks through the rest of the year. They're being continued because of ongoing economic uncertainty due to the pandemic. The news is likely to disappoint lenders such as JP Morgan, which had already indicated it wanted to resume buybacks. European regulators are set to start an accelerated review of the potential coronavirus vaccine from Oxford University and AstraZeneca. The so-called rolling review allows regulators to see trial data while development is still ongoing. Reuters is reporting US regulators have widened the investigation into the incident that led to a halt in the trial. The format of presidential debates is changing. That's after the first chaotic clash between President Donald Trump and Democratic challenger Joe Biden. The organizers say they want to provide a more orderly exchange of views. Biden says candidates should be able to speak uninterrupted, but the Trump campaign says rules changing are moving the goalposts. Financial services firms in the UK have shifted about 7,500 employees and more than £1.2 trillion to the EU ahead of Brexit. That's according to a new report from EY. And it says more are likely to follow in the coming weeks as the end of the transition period looms. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now, it's one of the biggest exchange halts in living memory. The Tokyo Stock Exchange, the world's third largest bourse, has shut trading for the entire day. Now, the operator plans to restart the system, aiming to resume trades tomorrow. That's what it said in a press conference this morning. Well, joining us to discuss all of this is our Danny Berger, looking at the markets. Danny, I mean, this is a pretty big deal. Did we learn any more details during the press conference of actually what went wrong this morning?
So, Francine, the press conference is still ongoing at this moment, but the Tokyo Stock Exchange doing its best to explain the issue at hand, saying that initially what happened is they had a hardware issue, and then they tried to change their systems over to a backup system. And that's when we got this glitch, ultimately leading the bourse to decide to close all trading for the entirety of the day. Now, they say going forward, their plan is to restart the system and have it up and running by tomorrow. Now, the fault, they say, lies within what's called their Arrowhead trading system that was developed by an outside company, but extremely apologetic in this press conference, Francine. The Japan Stock Exchange Group saying that the fault lays with them, and they regret how the announcement was given to the public, but they wanted to take their time, really understand the issue at hand before they gave more details about why exactly the exchange had been closed and their plans for reopening it.
Danny, what's the current sentiment in Japan? Or what are traders saying?
Francine, I've heard a lot of frustration. I've been up since 3:30 a.m. in London talking to different traders in the region who said at the beginning there was silence, deafening silence is what they called it, saying that it was unimaginable that they hadn't stress tested their backup system to make sure it had this occurred that they could handle it. One trader said to me, "It's a comedy show and making my eyes water. I'm not sure if from laughter or sorrow. It exposes just how antiquated the technology is in Tokyo," saying it's pieced together by chewing gum and rubber bands. Of course, we know it's not obviously a hyperbole there, but still, Francine, that gives you an idea of the sentiment, this idea that Yes, they are trying to explain at the moment what happened, but really just surprise from the investor base that they didn't have a better business continuity plan, rather. And although most big Japanese firms do operate on dark pools, so outside the normal exchange, you can definitely expect traders to vote with their feet, no longer use some of the exchanges affected by this until they're absolutely positive that this won't happen again.
Thank you so much, Danny Berger, there with the very latest on what's going on in Japan. The U.S. House leaders postponed a vote on a Democrat-only stimulus plan. That's to give Speaker Nancy Pelosi and Treasury Secretary Steve Mnuchin one more day to negotiate a compromise. Now, both say they're making progress. President Trump has also signed a stopgap funding bill averting a showdown of the federal government. Well, joining us today is Adam Cole. He's Chief Currency Strategist at RBC Capital Markets. Adam, great to have you on the program. What will support dollar? Are we going to have a stimulus in the U.S.?
Well, it certainly looks as if we're closer to a compromise and a vote. Ironically, however, given that cross-asset correlations are so strong in our markets at the moment, the immediate market reaction to that, however positive for the US economy it may be, the immediate market reaction to that would probably be to push risky assets higher, and with the dollar having re-established itself as a safe haven recently, to push the dollar lower. Longer term, I think it's a different story, but the immediate market reaction is good news is bad news for the dollar typically.
Adam, when you look at correlations, you know, what correlations in FX markets remain valid?
So looking at currency pairs versus proxies for general risk appetite, many of the historical relationships are as they were in the immediate wake of the financial crisis. So the Aussie, the Kiwi, the Canadian dollar all trading as extremely solid proxies for general risk appetite, and the dollar, Swiss franc trading as a safe haven on the other side of that. And I don't think that's going to change in the near term. So 60 to 80% of the daily variation in many of these currency pairs is explained just by whether markets are risk on or risk off. And until we get some variation back in global rates markets and some dispersion starting to open up in global central bank prospects, then we probably stay in this kind of default position where risk becomes the key driver. And that makes it difficult to play fundamental macro stories like increasing US fiscal stimulus and what that implies for growth differentials. Makes it difficult to play that in FX markets when we're constantly looking over our shoulder at what the S&P future is doing.
Adam, I know we've seen a little bit of momentum in dollar yuan, renminbi versus dollar picking up towards 6.7. Is this on U.S. politics or is it also on a changing Chinese economy?
It's the latter in our view. So to a degree, dollar CNY or dollar CNH does import its direction from general dollar direction as the currency has managed to get into basket, so it will tend to follow general dollar direction in that respect. But that isn't the whole story. There is an element of independent yuan strength if you look back over the last 2 or 3 months. And it's clear that the direction is more than just what the dollar is dictating, and that we expect to continue. We think the Chinese authorities are comfortable with some modest appreciation. The cyclical indicators out of China are still looking relatively good compared to the rest of the world. The downturn was short and we're now back in an upswing. And so long as that's the case, then some gentle appreciation of the currency is most likely going forwards.
All right, thanks so much. Adam Cole there from RBC Capital Markets stays with us, and then we'll get back to Adam and also ask him on pound. There's a story actually saying that the UK and the EU may have failed to agree on state aid. This is press reports, and it's actually moving pound lower. Now, coming up, also a conversation with the H&M Chief Financial Officer. That's in about 10 minutes from now. We look, of course, at the store closures and job losses. This is Bloomberg.
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Thanks, Francine. American Airlines and United will start laying off thousands of staff as originally planned, but both have vowed to reverse the job cuts if the government agrees to provide additional aid in the next few days. American is cutting 19,000, while United is laying off about 13,000. The moves raise pressure on Washington to agree on a new stimulus plan. Goldman Sachs is resuming job cuts. Sources tell us the firm plans to eliminate about 1% of its workforce, roughly 400 positions. The longevity of the pandemic is forcing the biggest banks in the US to re-examine plans to wait out the turmoil. Wells Fargo, Citigroup and JP Morgan are all planning cuts. Google has launched a pair of new 5G Android smartphones, the flagship Pixel 5 and the entry-level Pixel 4a. The Pixel 5's display is in line with the latest top-end phones from Apple and Samsung, but changes to its features and a lower price put the headset more directly in competition with their lower-end phones. That's your Bloomberg Business Flash. Francine.
Laura, thanks so much. Now, we're just getting a bit of breaking news out of a Reuters report. Says that the UK and the EU actually failed to agree on state aid, the pound dropping on the back of it. So let's get straight to Adam Cole to get his point on pound. Adam, do you worry that actually we don't get a deal, or does this just show how sensitive pound is to any, Brexit news?
I think it shows that markets have got a little bit ahead of themselves in terms of expectations for what we might get as the negotiations end today. And it seems that the short-term market probably is a bit too optimistic on a solution. And if we do get a deal, which I would say is no more than a 50% probability, but if we do ultimately get a deal, that's likely to come at the last moment, at around the middle of October or even later than that. So I think at the moment we should be alert to these kind of headlines, and the risk is that sterling pulls back as I say, markets have got a little bit ahead of themselves, thinking we may get a solution as soon as this week.
Adam, it also just shows, the enormity of the task at hand, as one of our strategists is writing in our MLive blog. What are the chances that we do get a deal by December 31st, and where do you see pound if we do?
So I would say the probability of a deal is a little below 50%. So I think the most likely scenario, by a small margin, is that we do exit on WTO terms. The greater asymmetry from my perspective, however, is the way the market would react. So the downside, I think most would agree, it's kind of non-contentious, that if that were the scenario that played out, the downside for sterling would be significant. So we could see a move down as low as 120 if we got to December the 31st, and it was clear that we were going to simply exit and trade on WTO terms. But on the other side, if we do manage to strike a deal, I would see the upside from that as much more limited, simply because how sterling reacts in that scenario would depend on the nature of the deal itself. And the risk is that the deal was perceived to be more favourable for Europe than the UK, and key UK industries would be disadvantaged. And the upside for sterling, I would say, is quite limited in that scenario. So although I see the risk as reasonably well balanced around deal or no deal, the market reaction, I think, is asymmetric to the downside.
All right, Adam, thanks so much. Adam Calder, Chief Currency Strategist at RBC Capital Markets. Now, coming up, we speak to the H&M Chief Financial Officer after the retail reported earnings that beat estimates, but said it will close around 5% of stores. We'll talk about bricks and mortars versus online next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacquet here in London. Now, President Trump wants to strengthen the Supreme Court's conservative majority by replacing Justice Ruth Bader Ginsburg before November's election. Bloomberg's Jill Schneider reports.
President Trump can thank a 2017 Senate rule change for his shot at filling the Supreme Court seat. After Democrats blocked a vote to approve his first nominee, Neil Gorsuch, Majority Leader Mitch McConnell invoked the nuclear option by calling for a simple majority vote. That allowed Republicans to confirm Gorsuch and paved the way for Trump's second appointee, Brett Kavanaugh, as well. Democrats crying foul cite precedent. In February 2016, President Obama tapped Merrick Garland to fill the late Justice Scalia's seat. But because it was an election year, Republican senators refused to hold confirmation hearings. Democrats say Republicans should be bound by their own logic this election year. Either way, Senate Republicans will move quickly. A 2018 congressional research report found the nomination process historically takes just under 70 days on average. And most high court nominees do make the final cut. Since the Supreme Court's establishment, more than 77% have been confirmed.
Now let's talk retail, and pre-tax profit came in higher than estimated at H&M. But the retailer plans to close about 5% of its stores next year as the pandemic exacerbates a record inventory build it's been struggling to reduce over the past 4 years. Well, we're delighted to be joined by Adam Carlson. He's the Chief Financial Officer of H&M. Adam, thank you so much for joining us right here on Bloomberg. When you look at your online presence, I think online sales make up some 26% of what you're selling at the moment. How much will that increase in the coming years?
Thank you for having me. It's not a prognosis specifically we do, but obviously we see now that the last couple of years, the digital shift is still ongoing and potentially accelerating. So we believe that that share will over time increase. However, we also see that the majority of our customers still shops in both channels. So we really see the shift is ongoing, but there's still a strong position for our stores to contribute to the customer experience.
But is closing 250 stores in 2021 enough, given the shift to other channels?
Yeah, we believe that, and it's an ongoing assessment. We increased the estimate for this year from 40 to 50, so we constantly review this, and we review it from a customer perspective, where we set up a footprint that could best cater to how the customer wants to shop in a particular neighborhood, city, or region.
Give me a sense, Adam, of what categories have actually been stronger online.
We have seen all through mid-spring that the customers is tending to shop more on the need categories, so to say, the basic garments, the underwear, kids and baby clothes, and a little bit less prone to shop the more want garments and the more high fashion categories.
So what are the margins, what are the margin implications of the shift in terms of channel by selling more online?
We see that with the growth we have, we can utilize the investments we made over the last couple of years to really benefit from the scale that comes with a growing online channel. But overall, we see it as a totality, and that's also how we review the portfolio and the footprint, and to see that how do we cater to the customer needs and do it in a profitable way. And our key goal now is to work throughout this transformation of the industry in a solid and profitable way. So we see that they complement each other both from a top line and bottom line perspective.
Inventory has been high since a couple of years. Is there anything more drastic, Adam Carlson, that you need to do to try and get that down?
Looking at how inventory has fluctuated out of second and third quarter, it reflects pretty much the position we were in last year. And the difference now is that we've had a lot of stores closed. So we are overall satisfied with the level, and then our key focus now is to get back on the trajectory that we started on for fourth and first quarter of 2020. So our ambition then is now to get back on that track and continue to improve long-term the productivity of our inventory.
Given all the cancelled orders, what steps have you taken to support some of your suppliers?
We have worked very closely with our partners to ensure that we together, with the long-term relationship in mind, maneuver through this situation. So we were quite early out in placing new orders and so forth to keep the supply chain up and running, so to say, even though that the demand was extremely dampened for a short term. But we worked very, very collaboratively with our supply chain to ensure that we mitigate the effect jointly as well as we can.
Thank you so much, Adam Carlson there. Too short a time, we'll have to get you back on, but a very in-depth, some of the in-depth things that we need to look at. I'm Adam Carlson there, the Chief Financial Officer of H&M. Now, coming up, the world's biggest ETF provider has launched a synthetic S&P 500 tracker. We'll speak to BlackRock's head of iShares for EMEA, Stephen Cohen. Our weekly show, ETF IQ Europe, is next. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Welcome back to the Open. We're 30 minutes from the start of cash equity trading. Well, we'll have plenty more, of course, on that. But actually, it's the ETF show. I'm really excited getting you the ETF show and telling you exactly what's been moving and what's not been moving today. Let's get straight to our Danny Berger with what to watch for the rest of the day.
Good morning, Francine. Up on the board for you, I have FFLO Go. So this is your view into the biggest moves when it comes to the ETF market. So I'm looking at basically which regions got the most flow. So ETFs tracking different regions. And I'm looking over the past month since we've seen September wrap up. Now, in total, European ETFs had net inflows at exactly 424 million US dollars. But Francine, that's led by just one thing. And that one thing is flows into Switzerland. Switzerland tracking ETFs, getting nearly $400 million of inflows. Now, part of what that is, you have to imagine, is what's happening with the Swiss franc, the Swiss National Bank spending 90 billion franc on helping to prop up the currency. Now, what that might mean is it makes Swiss assets more attractive. The Swiss stock market certainly outperforming its other European peers, but it also might be a similar effect to what's going on in some of the other regions. For example, like Denmark, Italy, when you have the euro or the Swiss franc strengthening against your home currency, it might make it more attractive to jump in, because once you sell off that ETF and get your original currency back, you'll get more bang for your buck. Now, looking on the bottom there, we have Spain with $64 million worth of outflows. Interesting story there, because we had a lot of big M&A news in the Spanish banking sector over the past month, but that wasn't enough to attract investors in there. Perhaps the lack of dividends from banks, of course, banks very heavy in the Spanish equity sector, means that investors were moving away from there. And I should say this month was a weird one to invest. A lot of the movers, a lot of the gains we saw, at least for equity markets, had to do with various deal flow. And if you're an ETF investor, it can be extremely hard, if not impossible, to capture that deal flow, because of course you're investing in an index, not individual companies. So a little bit all over the place. Perhaps it was just a month of stock picking, Francine.
Danny, thank you so much. So grateful that you do this for us, the funds and flows, right at the start of the ETF show. Now, a volatile month, September ends with net flows into Europe's ETFs, but at the slowest rate in 6 months. We'll discuss what's hot as 2020's fourth quarter gets underway. Junk sells off while as investors pull money from high-yield debt. We'll ask what innovations we'll see in the region's bond ETF market. And going synthetic, the world's largest asset manager launches its first swap-based equity ETF. We'll speak to BlackRock's head of iShares for EMEA shortly. Now, joining us to talk about all of this, the funds and the flows, and exactly what we see in the markets, joining us is Stephen Cohen, head of iShares for EMEA at BlackRock. Stephen, great to have you on the program. How do you see this market evolving from now until the mid-2021?
Yeah, look, I think we've had an incredible 6 months. I think it's important to go back to where we were in March, April. We had pretty much record outflows from much of the ETF industry, particularly in fixed income. And over the last 6 months, we've seen that really not just turn around, but accelerate. As you mentioned, as you said on the opening of the show, it's tailed off a little bit over the last month. I think that's to be expected. Firstly, because investors have put a lot of money back into the market, and secondly, because I think when we look out over the next 3 to 6 months, and particularly the next 3 months, there are a lot of sources of uncertainty. Clearly, we have the US election, which is, I think, probably the biggest source of uncertainty. But we also have this kind of re-rise of infection rates in much of Europe, particularly here in the UK, which is causing investors to be a little bit nervous in terms of what does that mean for what has been a pretty, impressive and positive recovery thus far. So I think that the next quarter, I think we expect more volatility. We do expect to continue to see some of the flows trends that we've seen up until now. I think China has been an area of a lot of focus, particularly China bonds, given the yield pickup there, China equities as well. I think on a more structural basis, when you look into 2021, the big trends that we've seen over the last 6 months, and actually beyond that, remain very much in place. We are seeing a structural shift into sustainable investing, and we're seeing that very much in the ETF market. And we are seeing this continued acceleration of adoption of fixed income. And actually, I think that's a big catalyst from what we saw in the spring.
Stephen, if you are to protect yourself in terms of what you see for the U.S. elections, what kind of ETFs do you buy?
So we've definitely seen. So I mean, the great thing about ETFs is there's a pretty wide spread of options that are out there, and I think that clearly the first thing we've seen a little bit of risk off demand. So we've seen some, as you mentioned earlier on, some selling out of high yield and buying of rates, a government bond product, and that has been a trend over the last 2 to 3 weeks. We continue to see interest in quality, and I think that is something as a firm we continue to believe in. I mean, irrespective of the specific outcome of the election, I think in an uncertain environment where you still have this backdrop of coronavirus, strong balance sheets is going to be very, very important. So those are two areas, and I think that we believe that we've moved into a new, or we're moving into a new paradigm of inflation. That medium-term inflation will be higher than what we have expected coming into coronavirus. And again, I think that one of the things that we'll see as part of the election is actually this potential for even more stimulus. And if you do see that in many areas, then actually inflation expectations and inflation ETFs remain an interesting area given where we're currently pricing the market.
All right, thanks so much. Stephen Cohen there from BlackRock stays with us. Now, coming up, the world's largest asset manager launches its first synthetic equity ETF, relying on swaps rather than owning the underlying stocks. But why would you want one? We'll bring that up next. Also, the EU, we understand, is sending a UK formal infringement notice by letter. It seems that things aren't going to plan when the UK and EU are actually talking for the Brexit transition, pound falling to today's low. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, BlackRock has this week launched its first synthetic equity exchange-traded fund. The iShares S&P 500 swap ETF will rely on derivatives rather than owning the underlying stocks. Well, Europe's biggest issuer has, until now, resisted the move. Now, we'll get the thoughts, of course, of the company's head of iShares in Europe in a moment. But first, with the story is Athanasios Psorafagis from Bloomberg Intelligence. Athanasios, explain how this works and actually what the advantages are.
Sure. Good morning, Francine. So synthetics, they're not as a big a part of the industry as they used to be. They're about 15% of the total assets. But in some areas, particularly U.S. exposure, there is a synthetic advantage, and it all really comes down to taxes. With the physically replicating ETFs, there's a withholding tax on dividends, anywhere ranging from 15 to 30%, depending where the product is domiciled. Synthetics are actually, because of the tax code, able to bypass tax withholding. So there's a big tax advantage by owning the synthetic, because there's a little bit of tax drag when you own the physical. So this is really one of the main drivers why we've seen some of these synthetic products actually do really well recently. Over the last year or so, you're seeing more inflows into the synthetic S&P 500 products at the expense of the physicals. That being said, there are already S&P synthetic products on the market. Most of the large issuers already have a lineup, Invesco, DWS, Lixor, et cetera. And in fact, if you look at Invesco's S&P synthetic product, it actually is in the top 10 assets of all products on the market. So clearly investors see the benefit of using a synthetic. They understand how it's structured, and it looks like there is a use case for some investor bases. So I expect this product actually to do pretty well from an asset gathering perspective.
Thank you so much. Athanasios Psarophagis there from Bloomberg Intelligence. Now, still with us, Stephen Cohen from BlackRock. Stephen, you took the plunge. Synthetic ETFs, here we come. Is it going to actually broaden and open up the market?
Yeah, I think that the way we've looked at it is clearly. I mean, ETFs. This industry is all about innovation. It's all about evolution. And what we've seen, as was mentioned earlier on, is that there has been a growing demand over the last couple of years for a swap-based alternative to the physical funds, and that's what investors have come to us for. At the same time, and I think. More importantly, actually, is that over the last few years, there's been a real improvement in the ecosystem and an advancing of the ecosystem. And we've always said that there should be three criteria that investors should expect and should demand from any product, and particularly from these products. That there should be clear labeling. There should be greater transparency than there used to be around the way the products are structured and what's inside them. And finally, that there should be multiple independent counterparties, swap counterparties to any of these products. And that is where the industry has come to over the last couple of years. And that has really set up the opportunity to be able to provide investors what they are looking for, but with these standards that we think are incredibly important that investors should expect. It is very much focused, as was mentioned, on US equities, because that is where the demand is. And I think that's where the growth potential is, more so than a broad kind of opening up of swaps as an alternative to the broader physical range that we've obviously run and grown over the years.
But Stephen, do you see more demand for this kind of product? Will you be doing more in the coming quarters or years?
There's definitely demand. As I say, there's demand for this specific exposure. There is demand a little bit in what I would call the US equity space. That is really our focus. Beyond that, it's not something that we're focused on. I mean, beyond that, we remain very focused on building out our physical range, both in equities and obviously, the biggest growth areas, which are fixed income ETFs and sustainable, which are the areas where we really believe will grow the ETF industry over the next kind of 4 to 5 years here in Europe.
Stephen, is there a catalyst to actually grow, ESG ETFs more? Is it something that actually comes from outside the ETF space, or is it something in Europe that will mean that, demand will significantly increase?
It's a great question. I think what we've seen this year is probably talk turn to action. There's a lot of discussion over the last couple of years around how do I transition to sustainable? What does it mean? How should I think about it? We did a lot of work over the last couple of years in really setting out a range of products that had clarity. I think what investors are looking for is some clarity around what sustainable investing means to them, which means they need clarity and they need choice. And I think that's where the ETF industry can really play a huge role, and the indexing industry in general, which is actually around giving some standards for investors to be able to then make the right choice for them. That is starting to happen. Clearly, regulation plays a very, very significant role in this, and we're going to have to see how that plays out over the next 6 to 12 months. But it is the biggest, as I say, alongside fixed income, it is the area where we're seeing this catalyzation. I actually think the other thing that is happening is, as a result of the COVID crisis. I think many investors are looking at their portfolios in general and rethinking their portfolios in light of the changes in the macro environment. And that is going to accelerate their transition to sustainable as well. So the kind of combination of increased regulatory pressure, end investor demand, and I think the COVID crisis, coupled with, I think, what we have started to achieve within the ETF and indexing industry, which is really setting out some standards, giving investors some very clear choice that allows them to actually make that transition relatively cost efficiently. I think those are the things that are kind of catalyze sustainable investing as we look into 2021. And obviously, this is going to be a massive trend for years to come.
Stephen, thanks so much. Stephen Cohen there from BlackRock stays with us. Now, we also, of course, have much more coming up. Which ETF attracted the most money this past week and which saw the strongest outflows? Our leaderboard is coming up shortly. Up next, we also talk about the future of fixed income. Plus, we look at pound. A lot going on with Brexit and some kind of legal challenges between the UK and the EU. Pound down. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now let's discuss the future of fixed income. Investors have been pulling money from high-yield bond ETFs after just 7 weeks in the green. The sell-off has pushed the Bloomberg Barclays Global High Yield Index to a loss for the year. That's as stock market gloom spreads to the riskier end of the credit market. Now, still with us is Stephen Cohen from BlackRock. Stephen, before we get to that, we're closing in on December 31st. How do you trade Brexit through ETFs?
Great question. I think Brexit is one of those uncertainty catalyzers that we talked about earlier on. I think in terms of there are probably two ways to think about it. The first one is kind of the immediate, potential for volatility, and I think that we see people looking at kind of potential risk-off trades, like we said earlier on, around government bonds and things like that. I think the second thing is, how does it change your investment landscape on a longer-term basis? And that argues for more granular building blocks, and it argues for investors to think about, Europe ex-UK, the EU, the Eurozone. These are all different kind of parts of the broader European world, and clearly the UK and the European world as it stands today, that investors invest in, but I think are going to have to think differently. So I think we'll see more and more demand for those more granular building blocks over time, and thinking very, very distinctly around the kind of the fragmentation of the region and the UK versus the rest of Europe. In the immediate time, I think it's a cause of uncertainty, and I think it's going to cause investors to think more about the risk off and things like governments.
Stephen, we also wanted to talk about high-yield bond ETFs. I mean, there's quite a lot going on. I think like every 3 days there's a story about it. What do you think the real dynamics at play are?
Yeah, look, I think that there's always a good story that it gets a lot of headlines. I think you have to put some context around it. If you look since the end of March, when the Fed announced that high yield bonds would be part of, or high yield ETFs would be part of their program, we've had about $30 billion go into high yield ETFs globally. In the last 3-4 weeks, we've had about $5 billion come out. So that's less than 20% of what's come in the last 6 months. So I think we've also seen a huge spread tightening. And so, this market has had a great run. It is natural, given everything we've talked about over the next couple of next couple of months in terms of uncertainty, particularly in the US, and I think some of the concerns that are rising around coronavirus, and does that start to have an impact on some of the growth rebound that we've had, that investors, do some profit taking and take some risk off. I mean, our view is high yield still remains an attractive place to be, given the kind of lower forever rate environment we're now in, and the kind of implied default rates that you're seeing in there, and just the lack of yield, and the investors need income. So I personally think that this is something which is, first of all, in a high yield market, very much what you would call kind of just a short term, very rational kind of profit taking. I also think again, it shows the utility of bond ETFs, and what we've seen this year throughout the crisis, both in the sell-off and the rally and now, is that ETFs are allowing people to make very quick adjustments to portfolios in these types of market conditions, and that is a growing source of growth of demand for all types of investors in these products.
All right, Stephen, thanks so much. Stephen Cohen, we'll get back to Stephen in a second, but now let's also look at the week's winners and losers. Here's Danny Berger with your ETF leaderboard. Hi, Danny.
Hi, Francine. Well, these past 5 trading days, all about the Qs. That is the NASDAQ 100 ETF. Now, one version of it, listed in Italy, an Invesco one, got $400 million worth of inflows over the past week. That puts it at our #1 spot on the leaderboard. We have seen that big tech sector bounce off the bottom, so the dip buying continues unperturbed. Coming in at #2 there, that's Amundi's MSCI Emerging Market Fund. That got $230 million worth of inflows over the past week. Interestingly, there could be a bit of a political tilt to this. For example, we heard from Goldman Sachs this week saying that a Joe Biden victory would actually be good for emerging markets. We've seen some of the betting markets start to price in an increased chance that he does indeed win the presidency after this week's debate, saying that higher taxes and better relations with Asia and other emerging market countries would be beneficial for the region. Invesco also saying that because China wasn't discussed in the debates, that's also a positive for emerging markets. Now, looking at the loser board, it is full of corporate bond ETFs. Investors fleeing credit. Francine, is similar to what you're talking with Stephen about, but here we're looking at investment grade getting sold off in Europe. As fate would have it, they are BlackRock iShares ETFs, both at #1 and #3 spot there. We have seen some of the spreads widening from a range that was set in July. Perhaps also some concern about the Fed taking their foot off the gas pedal when it comes to giving liquidity into the market. And finally, that #2 spot there, that's an Invesco commodity ETF. It tracks the Bloomberg Commodity Index. We did see the dollar sell off over the past 5 days, but prior to that, there were some indications that the dollar might strengthen. That could perhaps attribute to some of the sell off in those funds there, Francine.
Danny, thank you so much. Danny Danny Berger there with the leaderboard. Let's get back to Stephen Cohen. Steve, when you look at some of the things, you know, that Danny was talking about, and if we focus, for example, on technology, there were also these new tech ETFs being proposed in China. What's the appetite like for European tech ETF products?
It is relatively high. I mean, I think that the two big themes that have come out of the last 6-7 months have been tech and healthcare. And if you look across BlackRock's platform, whether it's in our ETF business or in our active management business, our alpha business, tech and healthcare have been where we have seen the greatest demand, and that has continued through. Clearly, a lot of that is US based in terms of kind of where the biggest access is for investors is the US. But I think that is going to broaden out. You mentioned China, you know, Europe as a lesser so source of tech, but where I think that there is opportunities to invest in some of these themes, and technology is just one of them. We're definitely going to see demand. So I think the evolution of kind of these more thematic ETFs, which really do relate to these longer term trends, and technology just really fits across all of them, is something that we've definitely seen the last couple of months, the last 6 months. I think we'll continue to see that into 2021 as an area where investors do want to focus their portfolios.
Yeah, Stephen, how will healthcare ETFs actually change? As you know, there's a lot of focus, as you're saying, on this industry because of COVID-19 and vaccinations. Is there, is there a country in Europe that gets it better than others, given our ETF market in Europe is so fragmented?
I think it's fairly broad in terms of there are potential players that fit inside a healthcare ETF or a healthcare index in multiple countries in Europe. So from an exposure standpoint, it really is quite pan-European. From an investor standpoint, that's kind of sometimes where the fragmentation kind of kicks in. But again, I think the ETF allows you to kind of get past that and actually invest in a basket of these companies. And I think the reality of healthcare is it can be very, very volatile, and we've seen that. And so I think that's where, again, for many investors, the ability to take on through an ETF kind of a basket approach to across pan-European healthcare for what is happening today and what may happen tomorrow is actually is quite attractive. And particularly as we think about the potential for countries to bring back some of the healthcare, not just in terms of things like research and things like that, but even the chain. I think the supply chain will be the next thing that in many countries think about. What does the supply chain look like, not just the research and innovation, and therefore as a result, what do we need to own?
Stephen, thanks so much. Stephen Cohen there, head of iShares for EMEA at BlackRock. Now that's it for this week's Bloomberg ETF IQ Europe. We'll be back with more next Wednesday, 9:30 a.m. London time. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Legal action. The European Commission will send a formal notice to the UK over Prime Minister Boris Johnson's plans to breach the Brexit agreement. The pound sinks. Ursula von der Leyen speaks in moments. Technical difficulties. The Tokyo Stock Exchange halts trading for the entire day in its worst ever outage for the bourse. And labor pains. American Air and United will lay off 32,000 workers combined. Bayer says it may shed jobs and plans to cut a further 1.5 billion euros in annual costs. Initial jobless claims ahead of Friday's jobs report. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lackland, London, Tom Keene in New York. Tom, we started the day here in Europe a bit quiet. It's not so quiet anymore. So EU leaders are meeting in Brussels. And, of course, we have a couple of news regarding Brexit. So there's this legal challenge, which we were expecting, but could also point to things not going great. And then we had media reports about the fact that they can't agree on internal subsidies to the markets, which could point to a harder Brexit or hard Brexit.
What's the significance of October 1? We are on the first day of the fourth quarter. I mean, October 1 has a lot to do with this, right?
Yeah, October 1 has a lot to do with this, and actually, if you just look at the time frame for this, it's 3 months away. If you look at Brexit, Tom, I had a pretty good conversation on pound, which is very, very fragile. So it moves on any kind of intimation of Brexit with Adam Cole, and he says there's a 50% chance that actually the UK leaves the EU without a deal and goes under WTO agreements. That would be huge.
That's a big number, and good morning to Wolfgang Munchow, who's been way out front on these challenges as well. It's amazing, Francine. This just goes on and on. Do you get the real sense that, like, the end of this year is a real trip point?
I think so, Tom. I could be wrong because there could always be an extension, but it does feel like, this time, one way or the other, we'll know by what fate Brexit will be.
And to be clear, we're waiting for Ms. van der Leyen to speak, right, at any moment.
Yes, on a number of issues, including, of course, some of the recovery funds.
I'm just talking about this. I'm just talking about this, Francine, because I want to do everything not to talk about the debate.
We'll get to that, Tom. Leave it to us. You know we have to talk about it. We're just not telling you when yet. Let's get straight to the Bloomberg First Word News. In New York City is Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom. President Trump signed stopgap legislation that will avert a government shutdown. It will keep the government operating at current spending levels through December 11th. The country's spending authority expired at midnight. Neither Democrats nor Republicans wanted a shutdown weeks before the election. House Speaker Nancy Pelosi and Treasury Secretary Steven Mnuchin say they've made progress on a compromise stimulus bill. They plan to continue negotiations. Mnuchin tells Fox he sees an agreement costing as much as $2.2 trillion. The Tokyo Stock Exchange halted trading for the entire day because of a hardware breakdown. It's the worst ever outage for the world's third largest exchange. The operator of the Tokyo Exchange hopes to resume trading as normal on Friday. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom, Francine.
Ritika, thanks so much. Equities, bonds, currencies, commodities, equities. Well, I guess for now we go up 2 days in a row, up 19 on the S&P 500. Dow futures up 166. Let me give you those levels. We're moving so quickly. Back up 33.71. On the Standard & Poor's 500, 27,831 on the Dow. The VIX, we had a 25 handle right now, 26.02. The yield space is really, really interesting. Yes, there are higher yields. I would suggest, Francine, off stimulus talk, the 30-year bond from a 140, 141, rounded up out to a 147. That gets my attention.
Yeah, Tom, what also gets my attention is really pound fragility, right? So you can see that we're seeing a bit of pound taking a hit across the board on some of the headlines that we had earlier today. Now, this is, of course, the Brexit news flow, but it also shows the sensitivity of the currency to any Brexit development. There is the president of the Commission, Mrs. Ursula von der Leyen, briefing reporters right now. Let's see if we can listen in.
A breach of the obligation of good faith laid down in the withdrawal agreement. Moreover, if adopted as is, it will be in full contradiction to the Protocol of Ireland, Northern Ireland. The deadline lapsed yesterday. the problematic provisions have not been removed. Therefore, this morning, the Commission has decided to send a letter of formal notice to the UK government. This is the first step in an infringement procedure. The letter invites the UK government to send its observations within a month. And besides this, the Commission will continue to work hard towards a full and timely implementation of the withdrawal agreement. We stand by our commitments. Thank you.
Von der Leyen, you can see pound actually dropping by 0.7% against the dollar on the news. Tom, this is significant because it really underscores the tensions between the UK and the EU, but it doesn't really have anything, formally that we should worry about straight away. So the move is important symbolically, but it's actually of little consequences straight away. Let's now get straight to Maria Tadeo, who joins us from Brussels. Maria, again, this goes back to the tensions between the two countries, but it doesn't have an immediate consequence right now. We're just waiting then for the UK to respond to it.
Right, Francine, and I would really point to that final sentence from von der Leyen when she said, we're going to trigger this legal action. The UK will get a month to reply, but in the meantime, we'll still want to work towards getting a deal done. And that's the bottom line here. Both sides are still working on the deal. It doesn't really derail the negotiations at this point. It's just something that it was almost crystal clear that the EU would have to do because there was a deadline yesterday to pull this bill. The UK didn't do it. The EU, they always stress they care about the rules. If you don't, they're going to sue. But again, nothing very surprising here. The negotiation continues.
It continues for year after month, after week, after day. Maria, you have aged watching this in Brussels. What happens next besides a can moving down the road?
Well, there's going to be two things happening. One is the UK will get a month to say we don't want to go down a legal path, and they have time to respond to the allegations that the EU will push forward. By the way, Tom, everyone that I speak to in Brussels will tell you that the Europeans are crystal clear that if this ever goes to court, they are going to win this case. And then separately, the negotiation is going to continue. This is Michel Barnier is still going to London, still trying to get this deal. And at one point, the political leadership will have to begin and say whether Angela Merkel and Macron believe there's enough space to get this deal. So there's two things that are moving at different times. But again, the bottom line is that the negotiation goes on. This doesn't really derail anything.
Thank you so much, Maria Tadeo there from Bloomberg joining us from Brussels. And Tom, just to put it into context, I mean, an exchange of letters and some of the exchanges that follow explanations before it reaches the EU's courts is very, very common. I mean, they send out hundreds of these letters a year, so we're just expecting to have more clarity on what the UK plans to do with it. Okay. Well, to me, it just goes on and on and on, doesn't it, Francine? That's very well observed, Tom. It does feel, it's been years, and actually we still have no clarity on what each side really wants. Caroline Simmons now joins us. She's the UK Chief Investment Officer of UBS Global Wealth Management. Caroline, I mean, Tom's right. This just goes on and on and on, but we could have, or we're expecting some kind of resolution either way by the end of the year. How do you position your portfolios, given what's going on with Brexit?
Yeah, so I think, as you've been discussing, the main conduit for the Brexit volatility is sterling. What we've been doing is in looking at how sterling could react if there was a no-deal exit. It's not our base case. We believe that it's more likely than not that they will come to an agreement and have a deal. But if not, then the impact, for example, on the UK equities in aggregate would be relatively limited because sterling would weaken, which would offset the drag from weaker financials. So maybe single-digit negative performance for the FTSE 100. Meanwhile, if they do get a deal, then we believe that could unlock some of the attractive valuation discount that the FTSE 100 has against global markets. It's trading on a 30% discount on a forward PE basis.
Caroline, we're also looking at, a report by EY, and they were saying that I think there's like $1.6 trillion that have already left of financial firms leaving the UK to go into Europe, and 7,500 financial jobs will also relocate to Europe? Does it mean that actually there are certain capitals in Europe that will benefit from Brexit? And does it make you more likely to buy some of those equities?
So I think, this is a continuation of some of the movements we've already seen since the referendum. Obviously, companies have had to put their contingencies in place, and as we're getting much closer to the deadline, some of them are enacting on those. I would just say in the context of sort of relocation and offshoring, the amounts of people moving because of Brexit is much less than the amounts of people that have moved in the last decade as a result of restructuring of financial services and offshoring. But yeah, at the margin, it, I guess, provides, more emphasis on certain European cities. And we have seen some increases in the property prices, particularly in Germany, which could in part be linked to increased demand.
Carolyn, I have the clearest memory of UBS in the depths of the Brexit shock taking a lease property in London and outright buying it. It was the first show of faith in the London economy. Yesterday, we reported, Bloomberg reports, that Morgan Stanley is committed to London and they will look for office spaces as well. With all these gyrations, what is the state that you and UBS see of the London financial community?
So I think, in terms of availability of office space, there is an opportunity when new buildings come on stream for companies to actually reduce their costs by consolidating offices into a bigger office at a lower lease, for example. A lot of companies are also looking for, environmental requirements from their buildings, so they want newer buildings that are more economical. In terms of, the underlying property markets, we've just published our bubble risk index, which actually looks more at the residential markets, but I could share some of our takeaways from that if that would be of interest.
Please.
Sure. So we've carry out a survey every year looking at the risk that certain major cities could be in a bubble. The top 5 on our index this year are Munich, Frankfurt, Toronto, Hong Kong, and Paris. London ranks at number 9 on the list, so it is overvalued, but not in bubble risk territory.
Oh, come on, where's New York? All I want to know, Caroline, is about New York. Come on, where is it?
New York, you have nothing to fear. New York is number 18. So you're in just slightly overvalued, but almost fair valued. And what is interesting is that, even through the pandemic, we have seen property prices in most cities gradually rising.
Well,
there are only...
Well, Caroline, this is really interesting in the sense that everybody's trying to get beyond the pandemic. What is the UBS Global Wealth? What is the view of where that bridge is right now? I mean, property owners in New York and everywhere are trying to figure out if 2022 is the new 2021. Is it?
Yeah, so I think it will depend, obviously, on the pace of the stimulus that we get and the developments around the vaccine and the virus evolution. But clearly, the sooner we get progress on the virus, the better the recovery can be. In terms of, where we think the markets are going, we're pretty positive on equity markets overall. Yes, there's volatility, and we think people, can position for that. But generally, we see double-digit upside to equity markets from here, driven by the unprecedented stimulus, the economic recovery, and the earnings growth recovery.
Caroline, how much do you worry about all these job losses? I mean, we had a list. I mean, there's a number of people that are losing their jobs and families that could struggle in the future is absolutely staggering. What kind of furlough programs or stimulus are you expecting from the major countries? Yeah, and that's the key, is how the governments manage the sort of tapering, if you like, of their job support programs. It is possible for unemployment to rise and for GDP to grow at the same time, and that is what we are expecting. Obviously, if the pace of growth in the rest of the economy is high enough that it offsets those people who are unfortunate enough to be losing their jobs, then you can get that expansion. But clearly, if we don't get the fiscal support, then the unemployment rate can increase to much higher levels. And that's why there's so much focus being placed on the US fiscal stimulus package and when and how they're going to get to an agreement on it.
Caroline Simmons, thank you so much. Greatly appreciate it with UBS Global Wealth Management. Really interesting there on New York City being 18th on the list. Whether she's going to continue with us here. We've got lots to talk about. We really want to drive into the equity market dynamics that we see right now. In our next hour, Ian Bremmer again. I'm on the Global View, but you've got to talk to Ian Bremmer about the state of American politics, and we will do that in the 6 o'clock hour. Of course, G0 Media President and with Eurasia Group. Futures up 23, Dow Futures up 196. This is Bloomberg.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg Business Flash. Rolls-Royce plans to raise up to $6.5 billion in new financing. The jet engine maker's reserves have been shrinking because of a collapse in demand for the planes it powers. The financing includes a rights issue, a bond offering, and loans. Shares of Rolls-Royce are down more than 80% this year. JP Morgan has found that more than 500 employees got assistance from taxpayers aimed at helping businesses through the pandemic, and dozens of them shouldn't have. Bloomberg learned that the discovery that so many employees received the aid set off a hasty investigation inside the bank. And Brexit has prompted about 7,500 finance jobs and more than $1.6 trillion in assets to leave the UK for the European Union. That's according to the consulting firm EY. A report says more are likely to follow in the coming weeks as the end of the Brexit transition period approaches. And that's your latest Bloomberg Business Flash. Tom Francine.
Ritika, thanks so much. Carolyn Simmons with us, with the United Kingdom Chief Investment Officer for UBS Global Wealth Management. Carolyn, I want you to tell me about this reset of the love affair with American U.S. large cap equities. We had a correction. We're down 6% on S&P 500. Is it for real, the recovery?
Yeah, we believe it is. You get these rotations, particularly driven by the tech space every now and then. The average pullback, I think, is about 12% in a tech rotation. And obviously, that being a large component of the US market, it's dragged the US down. But I think what you will see going forward is probably a slightly more balanced performance of the market rather than just the US and tech leading the way. We're going to get a broadening out of some other markets being able to perform a bit better as well, as the economic recovery, underpins that.
What other markets?
We like the UK. We have the UK on a most preferred. It's trading on a 30% discount to global equities. It's under-owned, and it's offering 40% earnings growth next year.
But that, we also like... is on the assumption, Caroline, is that on the assumption that that we get a deal between the UK and the EU, or do you like UK assets no matter what?
We like the UK assets either way. Sterling is undervalued. Obviously, if we get a deal, then it's slightly more positive for the equity market in terms of it may bring the international investor back to the UK. As I mentioned, it's already under-owned. If there is a no-deal exit, then the currency should weaken a little bit, which would probably push the FTSE up anyway.
What does the US election mean for European investors?
So that's really important for us to think about, particularly at a sector level. If we get, for example, a Biden outcome, then we could expect certain sectors around autos and sustainability. So whether that would be utility sectors in the renewable space would probably benefit. If we were to get a Trump outcome, then you'd probably see the energy sector and possibly a bit more onshoring. So themes around automation and robotics would probably benefit under that scenario.
Carolyn, what are the use of bonds with where the nominal yield is? What's the theoretical justification now for owning such a low coupon?
Yeah, so this is the big debate, isn't it? They do provide the stability in portfolios. When you do get, downturns, the bonds still act in their defensive manner. So they're helpful from that perspective. In terms of our preferences in the bond space, we prefer to go for some of the areas where you are getting a bit more yield. So emerging market bonds, for example, where the income is a bit more attractive.
I look... Carolyn, at where we are in the reset here on Q4. Is this a moment of drama for you in terms of reset and reallocation, or is it sort of a Q4 steady as she goes?
No, I think it's important to, have a continual rebalancing of portfolios throughout the year on a regular basis as markets move. So, whether we're into one quarter or another doesn't matter so much. Obviously, we've had, the peak economic upswing, if you like, from the virus lockdown. So that's quite helpful for this quarter, but it will fade as we go forward. But our expectation is that we return to trend growth rather than, anything negative.
Caroline, when you look at the move to ESG, or certainly this was, one of the things that we heard from the Commission President, that there's going to be a lot more funding in European projects for sustainable projects. Is there investors that can actually take advantage of that, or are valuations quite high at the moment?
No, we believe sustainability is definitely a very important aspect. We've actually made it our preferred investment choice now. The markets are broad enough that you can access it, a sort of balanced portfolio approach. You can look at companies that are ESG leaders. You can look at companies that are ESG improvers. You can look at engagement strategies where you're actually, enabling companies to look at their actions and take a strong, stance with them to help them change. So there's a lot of different ways to access it. And we believe it is very much a trend that is only going to grow over time. And as you said, the results of the pandemic, the rebuilding better, and I think it's the $500 billion of funds that are being directed towards green type stimulus packages.
Dividends have probably been the main way to make money this century in Europe. When do you expect dividends to come back? And will you shun industries that don't go back to dividends?
So dividends will start to grow, obviously, when the earnings grow. For us, we forecast that next year. For the UK, for example, dividends cut about 40% this year, and we're expecting them to grow close to 20% next year. So we will get that return, but not to the full level. That may take a couple years. I think it's interesting to have an approach where you have a mixture. So, if you're in the tech space, you're in high growth companies with very low dividends, and we've seen what can happen in those areas when they fall out of favor. The market is very, very bifurcated in its positioning, and I think it's therefore important to consider some of these value styles, which include dividends, and have a bit of a balance in your approach.
Caroline Simmons, thank you so much. Appreciate it. With UBS. There's lots going on this morning. Of course, Francine, we're watching the various geographies of the Brexit debate.
Yes, we heard from the President of the Commission, Ursula von der Leyen, Tom, that actually, they're going to send a letter of legal challenges to the UK. Now, this is, it won't really move right now because we're expecting then the UK to answer back an explanation, but it has had an impact on pounds. So you can see the fragility out there that any Brexit news could actually move UK assets down.
Yeah, testing on right now, pound sterling at 128.38 off of a 128.20 low. Waiting for news there. Possibly we'll get some headlines, we're told, out of Ireland as well, on the movable feast of October 1. Of course, the first day of the fourth quarter, we want to give you different perspective on what is called alternative investors. Those are the investors who are all in cash. That's a joke. James Barry will join us from BlackRock, the Chief Investment Officer, Alternative Investments. This is Bloomberg. Good morning.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
5 years ago in Silicon Valley, you had money pouring in from China, money pouring in from family offices. We go through these things in Silicon Valley where things are overvalued. 5 years ago, probably should have been valued at 8 to 10 billion, and it's, I think today, I think it's a great buy where it is now.
Palantir and the mystery that it is a huge mystery, and it'll be fascinating to see over the coming quarters and years what Palantir does and how they move forward. It's controversial, to say the least. Not controversial is Jim Barry. He is with BlackRock Alternative Investors, and he comes to BlackRock as a sterling career in this strange world called infrastructure, which is front and center worldwide in the United States, and of course, maybe off the path from the election, but maybe not really. Jim, I got to get right to the election in the first quarter of 2021. As the good gentleman from Palantir said, money is pouring in. Is that money going to finally go to a global infrastructure build?
Really good question, Tom, and good morning, everybody. I basically think that infrastructure is one of the few areas that most governments seem aligned across the political spectrum, aligned to sort of using as a tool to sort of drive economic activity as we try and deal with the consequences of this, or the economic consequence of this pandemic. So it's definitely there as a tool to be used. I would counsel, though, that it's very hard to implement, and that's why it was talked about around the time of the GFC, but not a lot flowed. And I think that there's been some learning from governments, but it's tough. It takes multiple years to implement programs of privatization or public-private partnerships. And so it needs more than the sort of the policy headlines. It needs real implementation focus.
Jim, you're way too young a guy to remember this experience, but I remember being on the interstate where Dad stopped the car as we went down to a 2-lane highway somewhere in the vicinity of Indiana. It was somewhere within the reaches of Purdue University. I can't remember. That was Eisenhower's miracle. Where is the spirit of Dwight David Eisenhower and the Democrats to build this stuff?
Well, look, I think in a sense, again, I think that there is a spirit around wanting to make grand gestures as it relates to infrastructure, particularly in the United States, where the scale of the need is measured in trillions of dollars. That same interstate is probably still at 2 lanes, given the amount of repair work that has to be done on it every year. And so I think that it's there at a level, and I think it's not just Democrats, it's Republicans, but I get back to implementation. This is tough stuff to do, and you've got to equip agencies with the right capabilities, you've got to empower them and enable them to implement the programs that are required.
Jim, how big is the disconnect between fundamentals in the economy and markets?
So this is a great question, Francine, and I kind of characterize this internally here, where it's the fundamentalist, which I put myself in the category of as against don't fight the Fed gang. And I think that there's no question the pace and scale of the monetary and fiscal response, the blurring of monetary and fiscal in the last 6 months has kind of inoculated the market generally from the underlying scar tissue that this pandemic and its economic consequences is causing. And I think that while, in effect, so the tide started to flow out very strongly, the monetary and fiscal intervention put a break on that, but the tide is still going out. And I think the next 2 quarters are going to see that tension play out. And so in contrast to GFC, where it was very dramatic and the pain was there right from the start, I think we've been inoculated, but I think the pain is beginning to creep in now as we see lots of restructurings, lots of unemployment, and more permanent unemployment rather than the temporary unemployment we saw through the summer. And so I think the next 2 quarters are going to be very telling and see how that tension plays out.
So, and Jim, are you expecting the next 2 quarters also to give us a bit more of a sense of who's going to continue working from home and what that means for real estate? I mean, one of the stories that Tom and I were talking about yesterday was Morgan Stanley, and a viewer actually also brought this to my attention. Morgan Stanley looking for new headquarters. You know, unclear whether this is good news or whether they're downsizing because they're expecting people to stay at home more in the future.
Yeah, so look, let's be quite clear. Apart from the short-term pressures in real estate, and particularly certain sectors like leisure, retail, and hotels, etc., you know, there are big existential questions about, to my mind, the productivity of space, of which commercial office buildings is one. And, you know, on one side, the case is there that it's absolutely clear we will not have everyone in the office the way they used to be. And that's challenging for corporates, because I will tell you, it changes the nature of how we work together and some of the real benefits of us all being together in the one physical space. But it's absolutely clear people will want more flexibility, and corporations will have to respond to that. But it's also clear, even post-pandemic, I think there will be a requirement for more space per person. The densification of office space that was really a trend of the last 5 years is going to end. And so I think there's a dynamic there. But I do think that it's not the end of the office at all. We need it to effectively enable companies to build culture, establish values, and be productive.
You know, I've got a good understanding, Jim Barry, of like how LaGuardia gets done. And folks, this is the horrific airport in New York City, and I give major marks for the way it's getting done, the speed and the beauty of what potentially will be a world-class airport. Jim Barry, in the emerging markets, how does this stuff get done? I mean, you go into a consortium with people, but what's the catalyst to get infrastructure done in emerging markets?
All infrastructure, emerging markets, about it starts with government policy, has to start. Infrastructure is driven by government policy. And so you're looking at governments and their agencies, and you're looking at what programs they're developing. What you're looking for is a very stable legal context. You're looking for an environment in which you can do business, no corruption. And then you're looking for programmatic campaigns around series of assets that allow you to commit the resources to compete in those markets for those projects. And as you say, typically in consortia.
What will happen to private equity in the next couple of quarters, Jim?
So, look, private equity, I mean, is dealing with the challenges of its portfolio where, you know, certain sectors have clearly been hardly hit. But private equity has proven its worth through the cycles over the last 30 years as an asset class, and it will do the same again. I think the focus now going forward, though, will be in terms of new investment. I think very much looking for the areas of where there's just structural growth, fast rivers of opportunity. Where I think leverage and playing the leverage cycle is going to be less a driver. So positioning the investments in areas of fundamental growth. I think another area then is in the distress space. I think we're going to see a lot of M&A. I think you're going to see consolidations, restructurings, and I think you'll see a lot of public to privates in the coming couple of quarters.
Jim, thank you so much for joining us today. Jim Barry there, BlackRock Alternative Investors Chief Investment Officer. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. Tom, the presidential debate format will change in the wake of Tuesday's chaotic showdown. The commission that runs the debates won't say what changes will be made, but it said it wants to ensure a more orderly discussion of the issues. Joe Biden says candidates should be allowed to speak uninterrupted. The Trump campaign says the changes are, quote, moving the goalposts. The next presidential debate is October 15th. Joe Biden hammered President Trump on the economy during a train trip across the Rust Belt. Biden was speaking in 7 cities through eastern Ohio and western Pennsylvania. President Trump campaigned in Minneapolis. The president signed an executive order aimed at expanding domestic production of rare earth minerals. That may help with voters in Minnesota's so-called Iron Range. It also would reduce dependence on China. American and United Airlines will start laying off thousands of workers the next few days as scheduled. Both promised to reverse the furloughs if the government agrees to provide additional payroll aid in the next few days. American plans to lay off 19,000 workers. United will cut about 13,000. The European Union has started legal action against the UK over Brexit. Bloomberg's learned the EU will send a letter accusing the UK of breaching the terms of agreement. It's the first step in a process that could end up in a lawsuit at the European Court of Justice. And the Tokyo Stock Exchange halted trading for the entire day because of a hardware breakdown. It's the worst ever outage for the world's third largest exchange. The operator of the Tokyo Exchange hopes to resume trading as normal on Friday. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Thank you so much, Ritika. Now, coming up on Bloomberg Markets, Brian Moynihan, the Bank of America Chief Executive. That's a conversation, of course, on the U.S. economy, jobs, but also branches. That's at 3 p.m. in New York, 8 p.m. in London, and this is Bloomberg. This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Tom, tens of thousands of job cuts announced by major companies in a 24-hour period show a warning sign for the world's economic recovery. Now, the losses emerge ahead of two key reports forecast to show limited progress in the U.S. labor market. Joining us now is Simon Kennedy, Bloomberg's executive editor for economics. Simon, first of all, I mean, the numbers are pretty staggering. What does it mean for furlough programs or for extra stimulus from governments?
So this is always going to be the case that was most likely. So what you saw very early on in the crisis was a lot of governments produced furlough programs or ways of compensating companies to protect payrolls. And now, as they look to end, companies are starting to cut. Companies that are feeling they need to have to. Companies that we're seeing from Goldman Sachs. Companies that kind of took a hiatus from letting workers go until the crisis kind of took its time. Now Disney, Shell, others, big job cuts, and that's likely to be a theme that continues in these coming months as companies kind of react to a new normal.
Simon, does it mean, are these jobs that will be lost forever, or as soon as the economy picks up in a couple of quarters, is it jobs that could come back?
Well, the interesting thing to check now, and we'll be looking for this very hard in the data, is whether these jobs are white-collar jobs. As often happens in recessions, it's typically the blue-collar jobs that go, but these could be very much white-collar jobs, middle management jobs, and they're much harder to replace in a longer term. And when the economy picks up, it tends to be the blue-collar, first out, first back in. Many companies will decide that this is the kind of permanent state of affairs.
Simon, Olivia Rockman's article stopped traffic last night. I put it out worldwide on Twitter. She did it with an intern named Scott Landman. And Scott, you know, Simon, I look at this fabulous article which focuses on the percent of unemployed. You've been doing this for years. How unusual is 8% layoffs?
So these are big layoffs. This is a reaction really to the a once in a century crisis, and a lot of companies are going to feel that their business models have changed, they've lost demand. Even if they've not lost demand, their business models have changed for the future, and you are going to see this kind of permanent state of unemployment for quite a while. Certainly, there's not going to be a fast return, even in a place like the US where kind of jobs have bounced back. We might see some more of it in this week's payrolls report. There's going to be some permanent scarring here from this crisis.
Well, the permanent scarring's there, and I mean, I guess it goes to hysteresis and all that Blanchard and Summers and the rest of us talked about. Simon, is this something that gets done at the year end, or do you just see this as sort of a chronic sense to it through 2021?
I think we're here for a while. You know, there's this sense that furlough programs have ended, that temporary job losses are now turning permanent. Are you seeing that in economies around the world?
Simon, is there any, I mean, who's getting it right in terms of governments, either to retrain some of this workforce or actually, you know, finding them a better structure?
Well, obviously, retraining is kind of easy to say. It's one of these things that governments churn out programs for. It's very hard to kind of do it in a mass way, in a way that will line jobs up. Certainly, I think South Korea, for example, is one economy where they're actually trying to work out not just retraining in the current skills, but finding job opportunities for workers in industries of the future where they probably won't have that, probably will need to adapt. And so again, it's not just much retraining. It's, in some cases, it's training for new skills for new industries.
Simon, with your years of experience, an open question into Q4. What's the #1 theme you and your team are studying? What's the Q4 mystery for you right now?
I think this has been the topic of this conversation. It's what is happening to jobs. I think markets, to some extent, are wondering about inflation. And that's certainly a debate that you're seeing within the Fed, but it's a debate, I think, for some time to come. But the real job is what is we've seen that there's a story on Bloomberg today by Ender Curran, Rich Miller, looking at this. The world economy did much better than we thought it would do in the third quarter. The bounce back from the low of the recession was faster than people thought, and yet now we're seeing signs that it's going to be a grind rather than a bounce going forward. And I think any indications that grind is going to be harder, I think will be looked for. And I think an early indicator of that is jobs announcements.
Simon Kennedy, thank you so much. Really, really appreciate it. On short notice today, running all of our economic coverage at Worldwide. I really can't state the importance of the job story we put out last night. And as Mr. Kennedy alludes to, there'll be many more stories on this, including claims at 8:30 this morning, including Jobs Day tomorrow. This will be really the great focus that we, as we move to the first weekend of Q4. This is the conversation of the day. There's no question about it. Mr. Weston, with a Speaker of the House stimulus in the air. This is Bloomberg. Good morning.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
It doesn't make sense to a lot of people in Washington either, including me. And there is no excuse for it. People need to know that. I think that, you know, the Speaker and the Treasury Secretary are continuing to negotiate as we speak. I will say that, you know, the House where I served has now passed multiple bills, and this week we will pass another one, providing options, saying we are willing to negotiate, but you have to include support for some of the people that are hurting the most. I stayed focused on people's paychecks and on their pensions. And in Western Pennsylvania, that means a lot. And that's pretty much what Vice President Biden has done all along. So I don't think there are a whole lot of swing voters left now because he's already picked up most of them before Election Day.
That is a wonderful snapshot of arguably the most important person in Washington for Republicans and Democrats. That is Connor Lamb. For our international audience, he stopped traffic in the 2018 election by winning a Trump Republican district near Pittsburgh. Connor Lamb with our Kevin Cirilli there just prior to the debate. And our executive head, Tanya Chen, berated me and said, you are going to show that video into Ian Bremmer because it really describes a tension of the American political experience. Dr. Bremmer joins us now, president of Eurasia Group and G0 Media. Ian Bremmer, I'm sorry, it's not about Speaker Pelosi or Senator McConnell and the rest or the British or whatever. It's about politicians like Connor Lamb who are trying to win 58 to 48. Explain the importance of those politicians worldwide to the leaders struggling to work out of this pandemic.
Well, I mean, you know, the politics in the United States, of course, is incredibly polarized. And there's not much space in the middle, not in the media, not for public intellectuals, and certainly not in politics right now. And, you know, given that, and the desire for those in the media to try to get these people whenever they can when things are uncomfortable, when politics are made challenging, it's an impossible position for them.
Do you buy the idea, Ian, that for people like Connor Lamb, it is about the economy? There's all these other topics, and you and I could bore everybody with a post-debate analysis and that. But is it just about the economy in the final analysis?
I think coattails matter. I think how people vote for the president has incredible down-ballot impact in a presidential cycle, in a 4-year cycle. I mean, look, the likelihood if Biden ends up winning this thing, that Senate itself is swung, which will have generational impacts on American citizens, is real. It's probably, you know, a majority likelihood if Biden wins. If Biden does not, it's not the case. No question in my mind that who decides to show up, how many people vote because they're voting for the presidency is going to impact how people are doing in Congress. And, you know, let's be clear, turnout is absolutely critical. And in this election, it's not just turnout, but how many of those ballots end up actually being counted opposed to those that are contested. Both of those things are pretty unusual, but they're very different in a presidential cycle than in 2018 or 2022, when turnout is going to be a hell of a lot lower. And of course, you don't have on the ballot the president.
Ian, you put out your futures risk report today. How does COVID actually change what happens to populism down the line? Could it actually spur and make it ugly?
The good news is in Europe, because the European response has been so robust, populism is actually decreasing. I was talking to the Greek Prime Minister just a couple of days ago, who describes the redistribution coming from Brussels and Germany and the rest as a Marshall Plan for Greece. $80 billion to them over the years. The Italians, the Spaniards, others feel the same. And that's actually making the populations less Eurosceptic, more pro-Europe. So it's nice to be able to wake up and say something reasonably optimistic that comes off of this crisis. But you're right, of course, in other parts of the world, including here in the United States and many developing countries, those that aren't handling the crisis as well aren't being perceived to. The pain is being felt on the back of not only the poorest, but also frequently minority populations. In the United States, Black Americans, Hispanic Americans, and other countries, Muslims, the rest, and that makes life a hell of a lot worse in terms of knee-jerk populism and anti-establishment sentiment. It will grow.
Ian Bremmer, thank you so much, and we will continue. We're thrilled to bring you Dr. Bremmer here with this important report from AXA, a really, really interesting report on the secondary follow-on effects to this horrific pandemic. So we're really looking forward to giving that to you. And yes, somebody's already emailed in and said, are you doing the New Year's Day soiree with your Eurasia group? And we're in intense negotiations on who will have the right donuts on that 1st of January show. Coming up on Bloomberg Markets, this is important. One of Francine's favorite people, David Miliband, International Rescue Committee Chief Executive Officer. An important update, not only on what we hear from Dr. Bremmer and the pandemic, but David Miliband as well. Look for that in the 1 o'clock hour. Futures up 29, Dow futures up 229. Next, Ian Bremmer. This is Bloomberg. Good morning.